Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next 20 minutes or so talking to you about the COVID-19 pandemic and the impact that it's having on the global economy and investment markets. I'd also like to share some thoughts with you about Adviceworx' view on the current investment climate and prospects for the rest of the year. The past few weeks saw massive gridlock in China's main container harbors Shenzhen and Guangzhou, with waiting times skyrocketing from half a day to up to 16 days. A sudden COVID outbreak in southern China has disrupted port services and delayed deliveries. Since COVID cases started spiking in Guangdong province, authorities have moved quickly to shut down the area to prevent the virus from spreading. This has resulted in shipping delays and disrupted supply chains, which in turn is fueling global inflation. By Friday night, nearly 179 million COVID-19 infections had been reported worldwide, and nearly 4 million people have now succumbed to the virus. The United States remains hardest hit, with 34.4 million infections and more than 617,000 deaths. India, Brazil, France and Turkey still make up the rest of the top 5, and South Africa remains in 19th position in terms of the most recorded cases. New COVID cases fell by 150,000 or 6% this week. India, Argentina and the United States all saw substantial declines. Russia, Indonesia and South Africa were the large countries with the highest increases in infection rates. Many experts have expressed concern over Brazil's decision to host the Copa America football tournament despite signs of a new COVID-19 surge there. The global COVID death toll declined by 7,000 or 11% this week. India, the United States and Argentina were the main contributors to this reduction as well. Bangladesh, Indonesia and Bolivia experienced the biggest increases in weekly COVID deaths, with South Africa not far behind. The highest fatality rates relative to population size were recorded in Colombia, Argentina and Paraguay. By Friday night, 1.65 billion people, or 21% of the world's population, had received at least one dose of COVID vaccine. Daily vaccinations worldwide averaged more than 35 million this week. China has now administered 967 million doses of vaccine, followed by the United States with 315 million and India with 263 million. Assuming similar ratios between single and double dose vaccinations in the US and China, around 1.2 billion people, or 15% of the world's population, can now be regarded as fully vaccinated. 400 million of them are Chinese, 148 million Americans, and 48 million Indians. The US Federal Reserve has finally envisaged hiking interest rates, but plans to keep increasing the money supply through bond buying. United States retail sales fell in May as people started spending on services and stimulus checks ran out. Investors are still buying US stocks and bonds, while China is slowing down and deflation continues in Japan. The International Labour Organization has warned that unemployment will not return to pre-pandemic levels, and Britons will have to wait a month longer for Freedom Day. The single biggest threat to continued global economic recovery is rising inflation. If inflation rises further and stays high for longer than currently anticipated, central banks will have to raise interest rates, which will in turn dampen global demand. This scenario looks more and more likely as most major economies, except Japan, have seen significant acceleration in their inflation rates of late. Among them, India, Britain and Canada have each experienced inflation rate increases of more than half. Despite growing headwinds, business leaders remain optimistic about prospects for the rest of the year. The JP Morgan Global Composite Purchasing Managers Index rose by 2 points in May, with all underlying readings except employment above the threshold of 50. This is the index's highest level since before the global financial crisis. A recent United Nations report warns that drought and water scarcity are set to harm mankind on a scale that will rival the COVID-19 pandemic. Drought, like a virus, tends to last long, has a wide geographic reach, and causes knock-on effects. According to the report, around 130 countries risk water shortages over the coming decades, among them China, India, Bangladesh, and Turkey. Ironically, countries like Bangladesh also face a heightened threat of periodic flooding thanks to rising sea levels. The prospect of higher interest rates had a number of ripple effects. Equity and commodity markets retreated, and the US dollar appreciated against most currencies. China's decision to sell part of its commodity stockpile added to the pressure on commodity prices and the shares of commodity producers. The US bond market was resilient, however, thanks to the Fed's undertaking to continue buying bonds. Airlines are hiring aggressively, and General Motors is doubling down on its commitment to electric vehicles. Most global equity markets ended the week in the red, with the Taiwan Weighted Index one of the few exceptions. The Dow Jones and China's A50 index have endured a torrid month, while China's rebel province has prospered. The French CAC 40 is still the best performing index for the year to date, and the A50 the worst. Over 1 year, the Russell 2000 and FTSE are at the front and back respectively, and over 3 years, the Nasdaq and FTSE. Commodity markets were buffeted by a number of adverse developments this week. Concerns over continued global growth, a stronger US dollar, and the prospect of China flooding the market with stockpile sales. Cobalt, iron ore, and oil were the only commodities to end the week significantly higher. Gold, copper, and platinum group metals all fell sharply. Coal and oil are still well up over 1 month, while lithium was the big loser. For the year to date, lithium remains the top performer, with coal, oil, and iron ore the other big gainers. Gold and platinum are now both in the red for the year to date. 18 months into the COVID pandemic, most asset classes are substantially more expensive than before. This is largely due to massive fiscal and monetary stimulus. The low interest rates and bond buying by the US Federal Reserve have combined to weaken the US dollar until recently, and resulted in strong rises in asset prices. The MSCI World Equity Index is up 25% in dollar terms since January last year, the S&P Commodities Index 21%, and gold 22%. We remain positive about global equities. Corporate earnings continue to grow in the current low interest rate environment. US price-to-earnings ratios are looking stretched, but equity earnings yields remain more attractive than bond yields. Pan-Europe offers better value, but the most attractive valuations are to be found in Japan and emerging markets, including China. We are, however, keeping an eye on what happens to inflation and interest rates and will react if they take a turn for the worse. For now, we remain underweight global bonds as yields remain unattractive, and if mandated to invest in bonds, we prefer emerging market bonds over those of developed markets. We retain a neutral weighting with regard to global property. Our least favored sectors are retail and office property because e-commerce and work from home could do long-term damage to their profitability. Conversely, these two trends are positive for the industrial and residential property sectors. The hospitality sector should recover in due course, but only once vaccinations have achieved critical mass. On Wednesday, South Africa commemorated the 45th anniversary of the youth uprising in Soweto. Now a public holiday known as Youth Day, the 16th of June reminds us both of an heroic past and a depressing present. South Africa's youth is in a bad way thanks to a failing education system and the highest youth unemployment on earth. Officially, 61% of South Africans between the ages of 15 and 24 are unemployed, but if we use the expanded definition, which includes those not undergoing education or training, the number rises to just under 75% of young South Africans. As of Friday night, just under 1.8 million South Africans had tested positive for COVID-19. Friday saw another 118 COVID deaths, which brings the total to 58,441. Amidst an alarming surge in new cases, particularly in Gauteng, government has announced that members of the SANDF will be deployed to assist with patient care and vaccinations. Nearly 2.1 million people have now received at least one dose of vaccine. Just under 500,000 of them are fully vaccinated. This week sees the start of a campaign aimed at vaccinating 500,000 teachers and education workers. The Finance Minister is adamant that government will not break the bank to give public employees the increases they demand, and fuel prices could go up again if the rand goes down. Businessmen are keen to generate their own electricity, but pastors and innkeepers are outraged at the new COVID restrictions. Kusile Power Station is set to become operational 11 years late and more than 80 billion rand over budget, and municipalities are owed more than R250 million, much of it by organs of state. One of the reasons why so many young South Africans are battling to find meaningful work is that they lack the skills necessary to advance in today's technology-driven economy. According to the latest Trends in International Mathematics and Science study, South African 9th grade learners were ranked last in the world in terms of mathematics and physical science proficiency. According to the study, nearly 2/3 of our 15-year-olds did not have even an elementary grasp of the fundamental principles of these subjects. A related problem is that too many of our children study humanities and too few scientific and technical disciplines. In countries like Japan, Germany, and South Korea, 20% of students study the former and 80% the latter. In South Africa, it is almost exactly the other way around. One of the biggest limitations of South African agriculture is that many farms are located in areas with marginal rainfall. During extended dry periods such as 2004 to 2007 and 2015 to 2016, confidence in the agribusiness sector tends to fall, which leads to smaller investments in equipment and area under cultivation. Thanks to 4 years of above average rainfall, the Agribusiness Confidence Index is currently at its highest level in 2 decades, which augurs well for our rural economy. Public sector employees have become the proverbial royal game of our labour force, thanks to the clout of public sector trade unions. As a cynic once put it, civil servants are like a rocket designed by government. It doesn't work and it's hard to fire. This graph shows how the wages of state employees, the brown line, have grown in excess of inflation over the past 13 years, while those of private sector workers, the blue line, have fallen and risen in line with GDP over the same period. The gap became particularly pronounced during the COVID pandemic, as many workers in the private sector lost their jobs or part of their income. Despite its relatively modest direct contribution to our GDP, South Africa's wine industry is a major employer, and its well-being is therefore important to the country. More than 250,000 workers were employed in the sector before the pandemic, and it contributed 55 billion rand to the national GDP in 2019. The lockdown has led to a decline of 7.7% in total sales, most of it locally, since the value of exports has actually risen despite a slight decline in the volume exported. Sadly, the number of wine farms has fallen by 25% over the past decade, while the number of cellars and the area under vines has also dropped. On the JSE, the All-Share Index ended the week more than 3% lower, with sharp drops in the financial and resources indices. The bond market and the rand also lost ground. Sanlam is taking over the life assurance business of Alexander Forbes, and Prosus has made an edutech acquisition in the Netherlands. Continued load shedding is taking its toll on the emergency battery packs in Vodacom's towers, and Goldman Sachs is clearly bullish about opportunities on South Africa's capital markets. Like most global equity markets, the JSE endured a sharp correction during the second quarter of last year. This was followed by a prolonged recovery, during which the All-Share Index rose nearly 18% above its pre-pandemic levels, the Resources Index nearly 30%, and Industrials more than 26%. The rand is near its levels of January 2020, but financials are still down 12.5% and listed property by more than 29%. Foreign investors seem to have lost their appetite for South African securities again. Last week, the JSE saw a net outflow of just over 4 billion rand, while nearly 2.5 billion rand left the bond exchange. For the year to date, the JSE has suffered a net loss of just over 20 billion rand and the bond exchange about 31.5 billion rand. The past year has been good to both local equities and local bonds, with bonds faring significantly better on a risk-adjusted basis. For rand bears, however, times were tougher. The local currency's surprising strength in recent months has caught out both currency speculators and prophets of doom about the local economy. How the rest of this year will turn out on the JSE will largely be determined by factors beyond South Africa's control, like United States interest rates and global commodity prices. We remain slightly underweight South African equities relative to our long-term strategic asset allocation. Domestic equities look cheap relative to offshore equities, both in developed markets and emerging markets, as well as relative to the JSE's own historical average price-to-earnings ratio. Despite the apparent value they offer, local equities remain hamstrung by the weak domestic economy and uncertainty over government's economic policy intentions. Despite the sharp recovery in the prices of some domestic listed property counters, we remain worried over the sector's long-term outlook and heavy debt burden. We therefore avoid property until the outlook changes materially. Domestic bonds remain our preferred local asset class. Yields remain highly attractive, and although we remain concerned over the long-term outlook for South Africa's government finances, we believe that a substantial risk premium is already factored into bond prices and yields. We prefer government inflation-linked bonds at the shorter end of the yield curve and nominal bonds higher up the curve. We are wary of corporate credit, however. It looks both risky and expensive. The Adviceworx asset allocation view can be summarized as follows. We remain overweight global equities because of the greater opportunity set they offer and our long-term concerns over the structural vulnerability of the rand. We are gradually adding to our local equity allocation and remain neutral on global property. We still avoid local property because of the uncertainty over the long-term health of the sector and hold no global bonds unless specifically mandated to do so. We are also maintaining our tactical overweight position in local bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make at least some sense of it. Should you have any further queries or questions, please don't hesitate to contact me or your Adviceworx financial advisor. All the best for the week ahead. Goodbye from me.